Welcome back. In this segment, we're going to talk about the matching your credit type with the type of purchase. So as an example, if you buy a building, that's a very long-term asset. You're hoping to realize the use of that asset over decades, maybe, if not decades, at least years. So you want to have long-term debt. You want to finance the credit. You want that credit to match the life cycle of the property that you purchased. So if you're expecting to use the building for the next 50 years, in a perfect world, you'd have a mortgage that spans 50 years. What that does is that spreads the payment, the cash outflow, over the useful life of the asset. Now, typically, I think most mortgages are capped around 20, 25 years. But that's the thing. If you buy a long-term asset like a building, even if you have the cash sitting around, it's better to borrow against the building and then use the cash that you have sitting around either to pay off shorter term debt, higher interest debt, because if you have long-term debt secured by an asset, you'll usually get preferred rates, and you, like I said, you're paying it out over time, so you're not spending all of your money today and then waiting for the asset to produce. Similar, I see people buying vehicles. They say, well, it's a point of pride. I've got cash. I'll pay cash for it. As a cash flow point of view, you're better to have the cash in your bank, invested properly, doing something productive, and borrow to finance the purchase of the vehicle. That way you've got money on hand if you need emergency repairs or things like that. But the biggest mistake I see people making is they use up their cash today to buy a very long-term asset. The other thing I see is people will use long-term debt. They'll borrow from a bank on a 10-year term to purchase short-term inventory that turns over in 30 days. So if you have inventory that turns over very quickly, typically you'd want to purchase that on a credit card or line of credit, short-term debt for short-term asset. Now, this is not a one size fits all, because some people, they like to know they don't have any debts. They want to know they're debt free. That's okay, as long as you always have enough money in the bank to make sure your business can go through a 3 to 6 month drought. Minimum 3 months, 6 months is ideal. So that's the big thing I would challenge you. If you've got assets, revisit the debt that is associated with each asset. Now, if you are one of those lucky few, you've got your assets all paid off and they're debt free. If you have a tough period, you can go to your bank and you can arrange long-term lending secured by long-term assets, or you can arrange short-term lines of credit based on short-term assets like accounts receivable. So that's a big tip, is make sure your credit matches your asset.